There are a lot of fees that arise in connection with just simply closing the deal and closing the loan. One thing that probably a lot of people are aware of is usually if you use financing, which is common to complete an acquisition, the fees of the lender's counsel are going to be paid by basically by the borrower or by the purchaser, and that's fine on a smaller deal. On a smaller deal where it's maybe a conventional lender where they may have form generated documents like Laser Pro, where some processor is basically populating those documents and simply has an attorney review them, because those fees will be substantially lower. If you get into more sophisticated financing like CMBS loan, that's where you have loan agreements that can easily be 100 pages long. And that's just one of probably a dozen or more documents that will be customized for the transaction, which basically means the attorney's fees are going to be multiples more than what you would expect from a standard conventional loan. There will also be various third-party reports and things like that that definitely add up in terms of things like phase one, zoning reports, any other third-party reports that a lender may want to see. And so one thing that I usually recommend on that, whether it's a sponsor or an investor communicating this to a sponsor, is to request an upfront estimate of what those third-party fees are going to be, rather than getting sticker shock when they see the settlement statement and realize how many expenses are part of the transaction.
Is that usually either projected or in some type of pro forma that is, I don't know if it's required, but is offered by a sponsor?
You can, in connection with the term sheet or the commitment letter, you can request that from the lender. And sometimes they'll have something almost off the shelf that they can provide, but sometimes they may have to ask their providers to provide that. But it's fairly common, and borrowers will usually receive that, particularly if the lender wants to get the business. And the estimates will be non-binding, but at least it gives a ballpark budget to the borrower as to what they can anticipate in that regard. Some of the other things that you'll see with some of the more sophisticated loans are various reserves that are required to be maintained. This can be for countless number of issues. Oftentimes, it'll be for, in the commercial setting, there might be a tenant that's a sizable tenant in the building, and they have the option to terminate their lease in, say, 2 years or a year and a half. And for an issue like that, where it's very significant to the cash flow of the project, the lender is going to want to basically have a reserve in place in the event that maybe that tenant does not renew, to basically protect their collateral, to protect debt service, and so on. And there are a number of other issues. There might be issues for deferred maintenance or capital expenditures, where the lender will have their report. They'll have some analysis performed as to what needs to be done to this property. And depending on what that report says, sometimes they'll have to have a certain number of reserves set aside for that as well. And so oftentimes lenders may, even if you have favorable financing, they may actually advance the proceeds for those reserves, but that may be something where you are definitely paying interest on those funds, even though you're not really using it for daily operations
Hmm.
um, of the property, but it's definitely a cost that you incur, and the lender is not advancing those funds for free.
Hmm.
So you're being charged for those as well. Some of the other things you'll see is in leases, if there are future allocations for tenant improvements, leasing commissions, rent abatement, and any sort of concessions in favor of the tenant that might kick in after closing. Usually the lenders will have done a pretty solid review of the leases, and they'll probably want to have reserves for those as well. And it's not uncommon that they'll want reserves for maybe 125% of that amount, just to make sure that when those events occur in the future, that nothing is going to basically impair the viability of the project or impair the debt service. And so they're going to want to make sure their funds set aside for all of those. And so those add up, particularly again for some of the more complex loans, but they're all situations where you're going to be paying interest on those. So that's something that can basically erode the returns